Hey everybody, welcome to Mortgage Today for Monday, November 13th, 2023, and oh, what a day it was. UMBS were down 14 basis points on the open, which seems like it's pretty much the standard answer lately, just kind of being down around 12, 13, 14 basis points on the open. U.S. equity futures pointed to a slightly weaker start for Wall Street following 2 weeks of robust gains as investors waited for inflation data that could show if the Federal Reserve is done hiking rates. Market attention is firmly focused on Tuesday's U.S. consumer price data, which are expected to show inflation easing to a year-over-year rate of 3.3% in October, down from 3.7% the prior month. 10-year Treasury yields slipped 2 basis points to 4.63 this morning, leaving them down about 30 basis points for the month. While several Fed officials have rejected the likelihood of swift rate cuts, money markets and economists are sticking with a policy easing bets. UBS is out with a call saying the Fed will cut the federal funds rate by 275 basis points next year. Morgan Stanley sees the first rate cut in June, while Goldman sees quarter four. I'm more in line with Goldman than UBS. That seems overly aggressive. Moody's downgraded the outlook for the United States on Friday from stable to negative, citing the mounting debt and the rising cost of servicing that debt. In the context of higher interest rates without effective fiscal policy measures to reduce government spending or increase revenues, Moody's expects that the U.S.'s fiscal deficits will remain very large, significantly weakening debt affordability. The U.S. will have to pass another stopgap measure once we hit the debt ceiling later this week. Given that bond prices are roughly where they were prior to the announcement, the markets appear to be taking it in stride. Monday had very little to offer in terms of calendar events or meaningful headlines to inspire bond market momentum for better or worse. The result is unsurprising if you ask. Treasury's 10-year yields are drifting very close to unchanged on the day after seeing early selling and a late morning bounce. If there's a development that's worth mentioning, it would be the MBS outperformance. Case in point, 6.0 UMBS are ending the day in line with Friday's 11 a.m. levels, while 10-year yields are more than 4 basis points higher versus the same baseline. As interesting as that may be, all bets are off after 8:30 a.m. tomorrow when the CPI drops. UMBS closed the day up 22 basis points at 100.41. The 10-year is back under 4.7%. So closing today at 100.41 puts us right in that very narrow range, right, pretty much right on that black Fibonacci line right there. So we have a very close 50-day moving average right below us, and then we have the 100-day moving average, which is, what is that, about 3/4 of a point above where we're at there. So we got a lot of support to the bottom. Hopefully that CPI number comes in pretty close to the estimate, although that doesn't really change the overall outlook because it's still in the threes when the Fed wants to see it down around 2. We also have news on commercial real estate, so this will impact the overall economy. The problems in commercial real estate are coming to a head as the problems in office expand to retail and multifamily. The Wall Street Journal had a story this morning about the problems in mezzanine debt, which is like a second mortgage for commercial real estate properties. Foreclosures hit a record this year in the mezzanine space, which is often a canary in the coal mine. It looks like a lot of creditors are not banks, but hedge funds and asset managers. But with asset prices in free fall, and banks will start to feel the heat. The problems in commercial real estate might be one reason why the Fed will need to ease sooner rather than later next year.